Hi, everyone. This is Jason Barrock of Wall Street from Main Street, and my co-host, managing editor of The News Doctors and independent financial journalist, Eric Dubin. Welcome back to another Welcome to Dystopia podcast. This is episode number 17. Our special guest today is a returning guest to our podcast channel. He's Louis Camarosano of Small Gold. He's a precious metals and real estate expert, and he also has experience working in technology companies and Wall Street, teaching, and he was also, I believe, a securities lawyer in Wall Street and in London for the investment banks. Louis, thank you for joining us.
Thanks for having me, Jason.
Now, Louis, there's a lot going on with the gold and silver markets. You cover the market very, very well. I'm glad you're getting more attention lately.
Thanks to you.
Yeah, I was going to say I'd like to think I have a little bit of hand in helping you out with that. But your research work is good. Just like Kuz Jansen when he was first discovered a few years ago. I think you deserved a lot of attention for your research work. Jeffrey Christian, you were telling us before the interview. Jeffrey Christian was on Bloomberg recently talking about silver demand. What is the CPM Group doing wrong?
Well, I don't know exactly what they're doing wrong. It's just that I don't think that they calculate the silver demand correctly. And it all arose from an article in Bloomberg written by Ed Vanderwalt, who is a decent reporter. And he was covering the prospects for silver in 2016. And most of the observers that he interviewed for his article mentioned that the silver supply demand dynamic is pretty favorable to silver. In fact, silver, according to the Silver Institute, has been in deficit for a number of years consecutively. And however, when you get to the bottom of the article that Mr. Vanderwalt wrote, there's a quote from Mr. Christensen that says, "No, we're of mixed minds. We're not really sure about silver this year because, silver's in surplus, plain and simple." Now, when I read the article, I immediately jumped upon it on Twitter, and I wrote to the author of the article, and I said, "Whoa, wait a minute! Silver is in deficit according to the Silver Institute." And the reporter wrote back, "Well, but the CPM Group is different. They have a different analysis." I said, "Yeah, but hold on. If you look at how the CPM Group determines the supply and demand dynamic, they exclude investment demand." So they show a surplus in silver when they take this silver supply, and then they subtract the industrial demand, and they come out with a surplus. I said, no matter how, he said, well, that's just how, people have different ways of analyzing things. And I said, no, supply and demand, you have to include all sources of supply and all sources of demand, plain and simple. I mean, you can't just say, well, we're only going to include the demand, and therefore we have a surplus in silver, which is crazy, because even the Silver Institute, even though they have a deficit, they have a little quirk in their methodology as well. They don't include ETF demand. And as you know, currently there's 550 million ounces in silver ETFs. So even with not including that, the Silver Institute shows a deficit. But somehow the CPM Group shows a surplus.
Louis, you doing thorough research for a mainstream reporter, that's too much work, man. It's much easier for the mainstream reporter to talk to one of his buddies that he has drinks with and just ask him for like a 2-minute quote.
Well, basically, I have to give him credit because he didn't just quote Jeffrey Christensen, he did quote others. And there was a contradiction in the story, because in the first paragraph, he had one of the market participants say that silver was in deficit. Of course, at the bottom, he didn't check. He has Mr. Christensen saying that silver is in surplus.
Now, you talked about Jeffrey Christensen not counting investment demand. Is he not counting any investment demand? Also, no ETFs, no coins and bars, no nothing.
No, if you look at these,
none of it. So he's not leaving out like one of those categories. No. He's leaving out everything.
Correct. Now, even the Silver Institute adds up coin demand, and I also, when I checked their numbers, I noticed that while they counted the coin demand pretty much the way I had counted it, by adding up all the sovereign mints and getting a coin number, they totally underestimated and just put in a number as a filler the privately minted bards and rounds, which, as you know, especially last year when there was a silver shortage, so to speak, in terms of getting Canadian maples and U.S. silver eagles, People were buying the privately minted rounds from the Sunshine Mint and other privately minted silver products. They had calculated the Silver Institute that while coin demand was up, if you backed out the numbers, the overall number for investment in silver coins and bars and rounds, they had actually come up with a number that was negative for 2015 for
That
silver
took a
rounds.
lot of creativity.
Yeah, and so it was interesting. I had covered it in a blog post, and later on, Steve Stanangelo contacted the Silver Institute, and they kind of gave him an answer like, "Oh yeah, well we really, you know," and they didn't really give a credible answer. It's just that they just didn't have the numbers. But my point is, okay, you could assume that if a silver coin demand was up dramatically, why would you think that privately minted silver rounds and bars were down in that particular year? So they're kind of disingenuous too in the way they undercount um, silver demand. But the CPM Group, by coming out with a number and just showing supply and demand and only including industrial demand and not including investment demand, which is by any definition now closer to 35 to 45% of overall silver demand, because coin demand in 2006 was only about 5%. But now with the dramatic increase in silver eagles, going from 3 million a year to 47 million a year, and the same with the Canadian Mint and the other sovereign mints increasing their output dramatically, coin silver bar demand is now closer, to 20% of overall demand. So you have to include investment demand. You can't just say, well, it's basically an industrial metal, it's a commodity. That's kind of what the CPM Group wants to portray silver as some type of commodity where a few collectors may buy a coin here or there. But that's no longer the case.
Yeah, I definitely agree. And Eric, you and the doc interviewed a silver refiner, I think the Sunshine Mint guy, right? And those guys have ramped up their production enormously. So if you ask one of those guys if investment demand for physical silver is up, since 2008, I think most silver refiners, maybe all of them, would say, yes, it is. I've had to, in the private sector at least, not a government mint.
Yeah, we had interviewed the CEO of the Sunshine Mint, and he had said since 2011 that their capacity and sales are tripled.
And in that interview, Eric, I remember that you guys asked him how. First of all, they're one of three private mints that have been outsourced to produce the blanks for the U.S. Mint.
And in fact, the lion's share, he isn't able to tell us what percentage they represent, but I would estimate it's probably at least 80% of the blanks that go to the mint.
But he also mentioned in that interview that they were also producing massive amounts of their own privately minted bars and rounds.
Yeah. Yeah, and, whether it's the Silver Institute or the World Gold Council and the antics that they do with their statistical methodologies, the industry across the board is really for want of real data. I mean, there's so many plug factors and assumptions and just bad analysis that goes into trying to wrap their hands around the elephant and describe what it is. And, it wasn't all that long ago the World Gold Council was just putting in plug factor for Chinese gold demand, for example, which is another great example. Back in 2009, when China made their second to most recent formal declaration of what they held in gold, when they moved it to 1,054 metric tons, they literally, the World Gold Council was off by hundreds of metric tons for years. And then they had egg on their face, and they basically said, "Oh yeah, well, okay, well, we'll just adjust our numbers and start all over again." And for the next couple of years, it was all just a BS fest.
Now?
I'm sorry.
Have they even aren't they off by even more than hundreds of tons a year now? Have they even acknowledged the Shanghai Gold Exchange?
When I was referring to their quote unquote estimate for the years leading up to the change in 2009, I was just referring to their formal estimate of what quote unquote are the declared holdings of China, and they don't go beyond that. That was part of the problem, is that they basically say we don't have official data, so we're not going to even attempt to estimate beyond what the formal numbers coming out of the Chinese government tell us, which is as much as like looking up at the sky and saying, okay, I think it's blue.
Right.
But it may be a rainy day for all you know. They just didn't even look at the sky. They just don't care.
Yeah, I mean, this industry is there. The stats, the data is corrupted I don't whether it's intentional or unintentional. We could argue probably all day about that.
Sure.
You know, some people have different motives, whether it's Jeffrey Christian with the stuff he said in the past about GATA and people like that. And then, you know, Jeffrey Christian has admitted with the GATA hearings and thing about the paper market leverage under oath for gold and silver futures contracts and over-the-counter derivatives and things like that.
He actually protested
you know,
about that little episode, saying, well, you guys have misconstrued what I was referring to when I spoke about 100 leverage.
But I watched that interview, and, you know, he said, you know, there's this many. So I don't know what can be misconstrued then, because he actually said it that, oh, you know, this is how the market functions right now is, you know, there's this many. So I don't know what he's trying to change about that afterwards. But I mean, the CPM Group, one of their primary functions, Eric and Lewis, I was talking to both of you before we started recording, is, you know, they help with the hedging for the miners. They help with the gold leases and the swaps and things like that. And, you know, that firm, the CPM Group, you know, they've been, Jeffrey Christian used to work a lot for Goldman Sachs and Jay Aaron and stuff like that. And he used to be, I'm not sure how close he is with Robert Rubin anymore, but at least he used to work with him for a while. So, I mean, obviously Goldman Sachs has funneled them some business in the past, and they're in charge of setting up, you know, hedging and swaps and things like that for the miners.
Yeah, it'll be kind to say that Jeffrey Christian is incredibly biased.
Okay, well, Lewis, we just talked a little bit about the problems with the demand side. Excuse me. I want to talk about the supply side, because you differ from other gold and silver experts on the silver supply side. Now, you've said that Mexican silver mining has actually been increasing recently. What do you think of the factors behind that then? Is it because of the cheap currency? Why do you think then the Mexican silver miners then haven't decreased production like I predicted they would?
Okay, so you and I talked a couple of months ago, and we talked about how the reason that the silver miners in general, or any miner in general, is still producing record output is because if the price of the commodity that they're selling goes down and they have bills to pay, they have to mine more in order to keep the ability to meet their payments. It's not that they want to mine more. In fact, because they mine more and they have to find less expensive product to mine, they go after the low-hanging fruit, which effectively makes it more difficult for them to mine later on. So what they're doing now is they're bringing forward production, and it's going to be difficult for them to meet these types of record output that they had. You know, I took a look at about 7 or 8 of the Mexican silver miners. The largest primary silver miner, Fresnillo, Great Panther, First Majestic, Endeavor Silver, they all had record production in 2015, and it doesn't make a stitch of sense for them to do it. But the way they achieved it was they went after all the low-hanging fruit, and, you know, there becomes a point where they won't be able to do this much longer. And even if the price rises, they've already kind of gone after their easy stuff. And so what Keith Neumeyer is doing is very smart. He's gone out and he's buying these companies that haven't developed their mines. They have, you know, done the research that the stuff is there. And Keith knows that when 2 or 3 years from now, when the primary miners and other miners are not able to get the amounts that they need to meet the demand, that the largest companies are going to come back to him and say, what do you got? You know, and then he can sell them those mines, and they will then go in and develop them. So it's a very interesting dynamic that you have this increase in silver mining production, because also there was a demand for it too. They're lucky that even as the price went down, which makes no sense at all, the price is plummeting while demand is increasing, and they're trying to meet the demand while the price is going down, and they're losing money doing it. And a lot of them aren't going to make it, either because they go bankrupt, or even if they don't go bankrupt, they've harmed their ability to mine profitably in the future, because they went after the cheapest stuff they can get, and that's all, you know, going to be gone, and they'll have to spend more money. And the other thing they didn't do, guys, they didn't invest during this time period in any exploration. So they have no idea of where their next, you know, 20 million ounces are going to come from.
Yeah, I mean, you're speaking generally industry-wide. There's been a few here there, like Keith Neumeyer at First Majestic, and we've had a few acquisitions here or there. You know, there's a couple producers like Silver Standard, who has the Piteria mine in Mexico that's going to come online in a couple years. That's a higher cost mine. That's a very large ounce one. And then you have, you know, a few more. Coeur d'Alene has added some additional greenfields and brownfields deposits onto a few of their mines in Mexico. So there's a few here there, but we're going to need a higher silver price. And I think you've definitely nailed it there, that, you know, the miners, if they would have cut back production like rationally we would have thought of, is some of them would have risked bankruptcy. So I guess they've done whatever they've had to do to delay bankruptcy as long as humanly possible. But, you know, the trade-off is that they've destroyed the economic mining plan that put these mines into production in the first place.
Right. You know, when you find yourself in a hole, you stop digging. But in this case, these miners can't stop digging. They
have to dig more.
Further.
But there have been there. I mean, it's also important to point out that, you know, some 65-70% of silver production is base metal and related to gold and other metals. And there have been closures of mines in that segment more readily than what you've seen in, you know, the primary producers that are going after the high grading strategies, et cetera. And again, too, you know, not all companies are created equal. I mean, you know, First Majestic hasn't been doing that kind of thing just because of the nature of the properties that they have and whatnot. You know, roughly $11 cost for production per ounce. So, you know, I on a net basis, I think it's important to stress that, you know, we are looking at a forward supply curve that's being chipped away at, and there's pressure in the industry. It's very clear that that's going to be a problem on a going forward basis, and I think that that's one of the underpinning, you know, supports to the fundamentals for silver.
And even Silver Institute and CPM Group do acknowledge that there will be supply constraints going forward. I think the Silver Institute says there's a 5% decline in 2016. I'm not quite sure where the CPM stands on it, but it's kind of obvious that they will not be able to keep up this level of production because they haven't invested.
Well, yeah, I think that a lot of source of production, like Eric mentioned, was these base metal miners for copper, iron ore, lead, and zinc, who had silver as byproduct, and they didn't care about the silver as long as they could hedge the silver or sell it as a silver stream to Silver Wheaton. We're starting to read articles now, though. The copper price has crashed in the last year or so. I call that. I was a little bit early, maybe about 12 months early, but I saw it coming. I saw it, a mile ahead, that the train wreck was coming. And, we're going to see a lot of bankruptcies in the copper market and base metal market in the next couple years unless we have a sustained rally in those. And I'm not confident in that. So we've had a little bit of rally here in oil. We've had a small little rally. It's been mostly, I don't think it's fundamentally driven, this rally that we've had in oil and base metals and things like that recently. I think it's mostly, just short covering. There's short sellers who made a lot of money and the trade was just really crowded. So I don't think that's a sustainable rally, a real bear market rally.
There's also a lot of news that keeps getting trickled out about a production freeze. There's going to be a production freeze. You keep hearing stories about a production freeze, and that tends to make oil rally as well. But there's no real change in the amount of production. In fact, the stockpiles keep growing.
When you say production freeze, are you referring to Saudi Arabia and OPEC?
Yeah, Saudi Arabia, OPEC, and Russia have been talking about it. Supposedly Iran's been involved, but Iran is balking at freezing the production. But apparently there's no real deal or any set amounts. And every time a story comes out, oil may rally on the concept there may be a production freeze. And then you hear, well, Iran says, we're not doing a production freeze until we get up to this level. Because remember, Iran is now just starting getting off the sanctions to send a lot of its oil into Europe. So the last thing they want right now is a production freeze at their currently lower levels than they anticipate getting up to.
Right. And historically, in terms of the percentage relative to their historic quotas in OPEC, Iran actually has a very valid case to, pound over the head of their fellow cartel members that, they deserve to have what has typically been their quota.
Correct.
So, just diving briefly in the realm of geopolitics, a lot of folk, particularly with, looking at headlines on Zero Hedge or what have you, they kind of paint Iran as being the bad guy when it comes to that whole disposition. And I think that's actually kind of painting it too far broad brush strokes.
I agree.
And oversimplifies it. But yeah, I mean, it's pretty clear that there's plenty of supply to come on stream if, in fact, prices go much higher, and that I'd say at least 3/4 of what we've seen alpha the bounce recently in, say, West Texas Intermediate or any benchmark you want to look at has been largely short cover driven.
Yeah, I don't think we've seen a lot of fundamental reasons where the supply has actually been cut off. I mean, I expected a lot of these shale producers a while ago to go bankrupt, and yet, they figured out a way to cut costs, keep raising capital. In fact, I think in the last couple months in 2016 year to date, the shale producers have surprisingly raised $10 billion in equity. So they've been still able to get, float junk bond debt, to increase the amount of debt outstanding, to keep raising capital. And it's like a similar situation, I guess, to what Lewis said with the gold and silver miners, how basically, they're going to keep increasing production or producing up until the last day they file for bankruptcy. So they're not willing. A lot of these guys are not, most of them are not willing to cut production. We've seen some hints of production cuts. That was with the two larger ones in the Bakken, with Whiting Petroleum and Continental Resources. But, they've said they're cutting production, but this rally in oil, maybe they won't. So we'll see until we actually get real production cuts, like large production cuts, a couple 100,000 barrels per day from a couple different producers. Then I'm not fully convinced that this is a real bottom in oil, like the mainstream media is saying.
It's kind of interesting. I remember maybe 3-4 weeks ago there was the announcement from the IEA about shale and other production in the United States, and we had about a 200 or so 200,000 barrel per day production decline in United States production, largely coming out of the shale patch. And then we had this short covering rally, and all of a sudden we started seeing other stories coming from different companies talking about, well, we'll probably be able to do some production at these prices and stick around. And so there you go.
Eric and Jason, normally in an environment where you don't have zero interest rate policy, QE, stimulus as permanent features of monetary policy, when a company has this type of loss and the losses are growing, the normal thing to do is to go bankrupt, to liquidate. But now the mentality is just raise more capital. And somehow they manage to find more capital because we're in this environment where capital has to go somewhere, and it's not going to go into fixed income stuff. It's going to go into speculative ventures like this. And because of that, they can continue to raise more capital.
Do you also think, Lewis, that the banks are willing to give a little bit more capital to buy another 4 months or 6 months or 8 months, just so that way they don't have to write off the bad loan that, here's another $100 million, so we don't have to write off the $5 billion or $10 billion loans we've given you as a total loss?
Absolutely. The term kicking the can down the road, that's, we started hearing that when they started QE and so on. Well, that's exactly what monetary policy and kind of bank mentality is now, is if you could just keep extending credit, you can kick the can down the road. And it looks like, when you have the ECB now buying corporate debt, they can continue to extend credit because they have ready-made buyers in the central banks.
Well, this is why I don't like fractional reserve banking either, because, the banks don't have the money to cover the loan loss reserves immediately. Right. I mean, if we read Austrian School Economics, and we could talk about this more later in the interview, Lewis, you wrote a good article recently about Austrian School. But, one of the main things about Austrian School Economics, talking about fractional reserve banking, Murray Rothbard talks about this, is how inherently unstable it is. So whatever the reserve ratio, even if it's 10%, if the banks give out a lot of loans and they have 10% reserves, they're still inherently insolvent.
Actually, he calls it fraudulent, not even unstable. Rothbard.
Well, fraudulent, in one of his writings, he called it inherently unstable and different degrees of insolvency. But it got so bad, Lewis, I think during 2008, that the banks had less than 1% of all loans reserves. So they didn't have any money to cover any loan loss reserves at all. It was below 1% in 2008. That's how much leverage was in the system.
That's unbelievable.
Sorry, go ahead.
I was just going to say, in your bank itself, the bank where you might keep your money, they don't have your money in there either. The amount of cash that bank has is a small percentage of the amount of the supposed deposits they have. I mean, if they do have the cash, if you go in there and try to get it and you try to ask for something more than a few $100s, they won't give it to you. They'll tell you to come back next week and they'll ask you more questions, and then they'll file a report on you as a
Oh
suspicious
yeah.
transaction.
Yeah, if you take out a couple thousand, due to the cashless society stuff being installed, if you take out a couple $1,000s of your own money from the bank, right, you're looked at as a T-word.
Right.
Even though it's your own money, right? Maybe you
Exactly.
need to go buy, maybe you need to go make a down payment on a car or something like that. You could tell the bank teller that you're making a payment for your daughter's car, and the bank teller is still going to look at you like you're a
And
terrorist.
they will file a report. You won't know it.
Yeah.
They have to file a suspicious report. In fact, I think it's almost like, police officers have to file a certain number of tickets a month, no matter what.
It is actually. I was just
the
going to
banks-
say that. They have quotas. The bank managers respond to corporate headquarters who are responding to regulators, and literally the tellers have a quota of, and it's not formal or anything, but they literally have to ask a certain amount to prove due diligence of taking care of, the fear of money laundering as the excuse is for this kind of activity.
Well, welcome to Dystopia, guys. Yeah. This is just unbelievable. There's the cashless society. There's negative interest rates in parts of Europe. Japan's doing it now. Members of the Federal Reserve are talking about it. Louis, do you think 10 years from now we're going to be looking back and just amazed at how, like, the people in power, the central bankers, the politicians, the people running these treasury departments, how they managed to keep everything together with bubble gum and duct tape and rules changes and things like that?
It could be, because the final coup d'etat is really going cashless and negative interest rates and then putting it all on the blockchain. Once you have that, then you kind of lock down the system. You've prevented people from hoarding cash. You can follow everything that they do in a cashless society. It's all on the blockchain. They can figure everything out, and then basically value will be determined not at the level of markets, but at what they say it is. And eventually, I'm going to put something out on this. I think that banks will be eliminated, and that governments will run the central bank, and everything will come out of there, and they'll eliminate that aspect of having to deal with private banks. Because if they can control the money supply, and this is kind of I don't know if you know the Swiss initiative, where they were trying to eliminate and put all the power into the Swiss National Bank. The governments love that, because now they don't have to have partners with private banks. And if they can just issue the money through the central bank and they can control what happens, they can do things for political reasons. They don't have to worry about where markets might want to take capital. They can just direct it because they control it. And I think that's really what's coming in 10 years. So you have negative, you'll have basic.
That sounds almost like the greenback then, about, Congress issues the money, how the greenbackers say, oh, well, Congress can, we trust Congress. We can issue Congress can issue as much money as they want because we trust them. It'll be debt free, so it'll be fine. Right. And that Lincoln didn't create a lot of inflation during the Civil War, and it was bad to go back on the gold standard and things like that.
And it sounds good, because what you're doing is you're going with the populist view against the big bad banks, but really substituting something even worse, which is one monopoly bank. And, well, it's our bank because it belongs to the government. Well, you know how that turns out.
Well, Louis, to understand more about what you're saying, just let me ask you a question. Are you suggesting that the government, say the United States, would take over commercial banking in total? I'm not sure.
No, they would take over not the commercial bank. They basically,
when you say one bank, are you saying that
one central bank? According to what they want in Switzerland, the populist movement is to put all the control and have no. You have a populist bank where the central bank, the bank of the sovereign, is the bank. They make the loans. They make the criteria for the loans. They issue the currency and the amounts that they wish.
And the key here in that example would be that the issuance of credit is not a private issuance of credit due to bankers, but due, in fact, to the state.
And
to
due,
the
in
Swiss
fact, not
nation.
to market conditions, meaning, okay, what's the cost of money? Already they set interest rates. But in this case, there would be no market. They would just loan according to how they wished capital to go in which places.
So full central planning then,
exactly.
Full cronyism.
So
that's what Keynes wanted.
Right.
That's what Keynes really wanted.
If you want investment in infrastructure, they just direct it over there.
So we want to. So the U.S. wants a full space program, then wants to do space mining and build a base on Mars. Hey, let's print $2 trillion in the next decade, no problem.
Right, and
So
then
then,
you don't have the bank middleman. You don't have the worry about banks and then the financial system collapsing or any of that, because
Yeah,
there is no private capital.
You know what's funny is Catherine Austin Fitts actually talked about this in her new newsletter in January, her preview of 2016. She's talking about the U.S.'s space program expanding. She said trillions of dollars in Black Ops money and off-the-books money has already been printed into the U.S. space program. That's where a lot of the extra inflation went into extra government contractors and things like that. So, maybe the elites, the people in power, they'll just print another couple trillion to invest in, new things like space, and then that inflation, that money, it doesn't get spent on Earth. It gets spent, for for building space stations and rockets and things like that to get out to build other bases on other planets.
One of the issues they have, populace, with private banks is banks make an economic decision generally on how to lend money and why to lend money based on the market. But under a central bank owned by the government can use social concerns. In other words, they can lend money however they feel it makes sense to benefit society. So that's not a free market concept. A free market concept is money goes where the market wants it to go.
So Louis, forgive me for addressing this again, because I don't think you fully answered my question. What are you envisioning when you say 10 years forward that in the United States, the central speak to the United States, or create a hypothetical example? What are you suggesting when it comes to the functions of commercial banking?
That there would not be commercial banks, that basically you would have all of the nation's currency on a blockchain. You would have no cash, and the central bank would be the Federal Reserve or something like it, and it would be operated by the government. There would be no shareholder banks in a private bank. It would be
it would be 100% owned by the government as opposed to the hybrid of the current system?
Correct.
Okay.
Yes.
So you'd have to get government. If you were a small business, then you would have to go to a government-run bank, and you'd have to get government approval. And if you had a bad post on social media, the government would say, you know what, you have a good business, but you said this post on social media, you're not getting the money. So it would be a lot like China then. How China now is like, if you have bad posts on social media, it affects your credit rating. So it would be similar to that, except even more draconian.
Yes, and I think the bank would lend money not just to cronies, but into areas where they wanted it to go, not necessarily where the market wants it to go. And because they control the entire money supply, they don't have to have laws and regulations. They just have to have a decision-making body that determines where the money's going to go. And if they're short money, they just print up some more.
Well, I mean, they've already been doing that to a smaller extent, but I guess they could do that another.
Yes.
They could do that another order of magnitude. Then I guess that's what you're saying.
Well, but there's different ecosystems in these different models. I mean, right now we have a commercial banking system that has its own set of interests run by bankers, and it's more of a corporatist kind of ecosystem, fairly described in its relationship to, the state. And I'm not so sure that, the banker's going to go quietly into the night and accepting a crony capitalist relationship with the state as a consolation prize in this vision of 10-year forward where the commercial banks fully go poof.
You may be right. This is just
well, sorry to interrupt you guys. I actually already view a lot of especially the big banks. I mean, the smaller banks, mid-sized banks, they don't have access. They're not protected by the Federal Reserve. They're not backed by nearly as much cronyism as the large banks. But I view the large banks, guys, as already government-sponsored enterprises.
Well, of course,
I mean,
that's true. But it's again, we're talking about the current state of affairs, which is largely and correctly fairly described as more of a corporatist, fascist kind of relationship. And I'm curious as to know whether or not Lewis is actually talking about something that flips towards the totalitarian direction of more of a socialist kind of outright pushing out of private interests and rewarding private interests in turn in terms of cronyism.
That's exactly
if literally the control levers of the creation of currency and credit within the system is 100% controlled by the state, which it is not right now.
Correct.
That would change the paradigm of which one assumes the overall state is fairly described, literally the nature of the government of the United States. And that's why I was backing up a bit and wondering and trying to ask you some questions to flesh out exactly what you're thinking. And now I do understand the theory that your hypothesis that you're presenting.
And the reason for it, Eric, is that that's what it devolves into, because no power entity wants to share power. The only reason the government shares power with the banks is because they have to. And the only reason the banks share power with the government is because they have to. But I foresee the government getting more powerful because more people are against the banks, I think, than the government. And the government has a way, because they make the laws, they can squeeze out the banks if they wish to do so. And they can have populist approval to do that. I mean, you got Bernie Sanders,
Yeah.
his whole reason is to be against the banks. So people not thinking very much would say, yeah, wouldn't it be better if the government, our government, owned the way money is flowing around? Not realizing that they're signing their own death warrant and having a totalitarian point of view. But I could see that happening in 10 years, especially with the development of technology, blockchain, and it gives the government total control over the money supply, which is something they want. And politicians can then much more easily, without lobbyists, just promise stuff directly to the people because they control the purse. They don't have to worry about getting elected by getting Goldman Sachs money. They just have to promise something, and then they just go to the bank, they print it out.
Well, social change in the zeitgeist might change massively after we have a gigantic crash.
Correct.
However, as it stands right now, it's very clear that the worldwide banking institute interests in the West, the really top concentration of wealth and behind Goldman Sachs and J.P. Morgan and all the other banker conglomerates, seek to have government as their bitch rather than they being the bitch of government. And this whole cashless society paradigm that's coming down the pike, at least with respect to how it's being kicked around in the brains and dreams of avarice of people like Larry Summers, and you don't have to go very far to actually see within the bowels of think tanks and appropriate editorials written by people in the establishment or whatnot, that you can tell what they're thinking. And it is, in my opinion, not about setting up the government to be the sole arbitrator of the issuance of credit because of the desire for government to control all commerce, but rather the power relationship, in my opinion, is one where the bankers continue to desire to have government be at their beck and call, such that government would influence the way credit is issued. And a cashless society would be kind of like changing the ways in which pipes are ordered so that everyone can spy on pipes, control pipes, shut pipes off, and digital currency can essentially be used as a power tool for
Eric,
social
can I ask
control.
you about negative interest rates? Negative interest rates make it more difficult for banks to actually exist.
Yeah, that's true. I mean, that's an artifact of, it's true, and it's also it's a little more
money other ways.
It's a little more nuanced in the sense that part of the reason why we have negative interest rates is the history of the system being so screwed up by the nature of the system to begin with. It's kind of like a catch-22 scenario where these idiots have created something so unbelievably unstable that we end up having crashes over and over again. And then the 2008 crash required, quote unquote, and I use those scare quotes advisedly, required the resuscitation of the system with the seeds of its own destruction thereafter. But you can't fix a credit or an insolvency problem with issuing too much credit.
Yeah, I mean, all this, guys, it all goes back to a dystopian, Atlas Shrugged type of scenario here, where you just have more Wesley Mouches, you have more James Taggarts, which are James Taggart's like one of the main crony capitalists in the novel for our listeners who aren't familiar with Atlas Shrugged. It's a long book, but we're starting to see small examples of Atlas Shrugged start to play out. There's a lot of examples of the 21st century motor scenario where, people are being forced to pay, higher minimum wage and things like that. There's a lot of examples of this in society where in smaller communities, people are forced to pay each other social program money based on need and things like that. If I could add to your points, though, from some of my sources, I actually had dinner a couple of weeks ago with a government regulator. I won't name his name because he listens to this podcast and I don't want him getting in trouble, but he actually got a presentation about digital currencies. So we have central banks and governments working on them on their own blockchains. And now we have Wall Street, the large banks on Wall Street. They're hiring the coders who were on the Bitcoin project. They're building their own blockchains, and they're going into these regulatory agencies like the FDIC and others, and the SEC, I'm sure, and they're giving presentations either directly to the regulators, or the higher ups who are regulators are giving presentations to the lower regulators, and they're telling people about the blockchain. Only criminals use Bitcoin. We're coming out with our own blockchain. It's going to be so much better, and we're going to divert a good amount of our business into these things. So that's the way things are going, guys, unfortunately. More control. And then, if you're a rebel rouser, or you anger the government, or you make a bad social media post now, I think, unfortunately, things are going towards the way of, what happened with Edward Snowden, what happened with Julian Assange. There's only a couple guys like right now who have angered the U.S. government that much, who have been completely, turned off financially from the system. But, there's going to be a lot more down the line, because it's going to be so easy, because things are going to be all digital.
And if you think about, people are very excited about blockchain technology, and they view it like in the overall as if it in general is a good thing. And I equate that to nuclear energy. It depends on whose hands it's in, because nuclear power works, it's good, but it could be a disaster. But even worse, it can make catastrophic bombs. The thing about blockchain technology, if you have the biggest, baddest blockchain, that's not a good thing if the governments have them and they run their own currencies on them. A lot of people that are into Bitcoin are getting all excited that blockchain technology is taking off. That's not a good thing.
Well, I don't know about that. I mean, blockchain. The thing about blockchain, first and foremost, is that it's a better mousetrap in terms of recordation technology. And
Correct.
the problem with digital currencies in the hands of the government is twofold. The nature of who gets to issue credit, first and foremost, and who owns the issuance of credit, in terms of the power that confers. And I need only speak to Mayor Rothschild and his famous quote about, I care not about, I'm paraphrasing, care not about who or whom runs governments, but issuing the money, in fact, is the true control. But the other thing, too, is that, blockchain in and of itself is pretty darn cool. It enables recordation and transaction and anonymity if it's done right. I mean, it remains to be seen what the beasts that are being created in the bowels of the banking system right now to compete with Bitcoin's blockchain. But, the blockchain in and of itself is actually a positive thing in all respects, with the singular caveat that it is more important to pay attention to who owns the credit creation process and how it's actually done. I mean, the blockchain is kind of like a patsy.
It's technology. It's any tool. A tool in the wrong hands is bad. It's dangerous, right? So that's what the blockchain is. I mean, there's smart contracts and other stuff. But the credit creation thing, that's an interesting point both you guys brought up about that. I mean, if we had a better monetary system with sound money, with wages falling, with prices falling, we wouldn't need as much credit in the entire system at all. We just wouldn't, because people would have savings. They would know prices would be going lower. There would be an incentive system in place for people to live within their means, and there would be sound money, and people wouldn't need as much credit for everything, with wages rising or the government forcing wages higher, and the government manipulators through inflation and other stuff trying to force prices higher. So because we have, a manipulated system where central planning and central banks and Keynesian economists are trying to forcibly force in the real economy wages and prices higher, this is what causes the need for credit. So, this is why the government is trying to underreport inflation and force wages and prices higher. So that's their excuse then to pump more credit in the system. Look, prices are going higher. We need to give people more credit. It's this is all, Louis. You've been in markets longer than I have. Do you think this is all one big disaster when you look at different countries and different markets and things like that?
Oh, of course it is. But the way they avoid the disaster is by issuing more credit. And there seems to be, and if central banks are going to, sop up the credit, then it can go on much longer than we've ever expected, because it has gone on longer than we thought it could go on. Once you, as quoting, paraphrasing what Eric said about Rothschild, I care not who makes the laws as long as I can control the money supply. once you have that kind of control, whether it's sole control as a government entity or control through a quasi-public central bank or through the network of too big to fail banks, you're kind of running the casino. And it's up to you as the owner of the casino as who to give more chips to. And that just keeps the players in the game. And that's why we haven't had a collapse.
Yeah, there's been an enormous amount of effort, guys. Like, the stock market, I think the stock market was setting up a couple months ago for look like a big crash maybe before the November election, but there's been an enormous effort to try to paint the tape again, to try to get a rally going in the regular stock indices. This is, while the fundamentals, individual companies in different industries report bad earnings, but the general indices are just propped up one way or another.
Did you see what Bloomberg actually reported on this, that what's upholding the stock market now the last month has been corporate buybacks.
Yeah.
So
and
basically,
then periodically for 2 years, that's been an ongoing, in fact, even longer than 2 years, it's been an ongoing support to the market, a huge support to the market. And it gets back to the, cheap credit.
Yeah, and it means that companies have no better use for their money than to buy back their own shares. It's self-dealing. The officers and directors make money off of it. But in the meantime, that money that they spend, that they borrow to buy back their own shares, doesn't go into research and development, doesn't go into hire people, doesn't go into pay for full-time workers so they can pay the Obamacare premiums. It basically just goes into buying back the shares.
Yeah.
Or into leverage buyouts, which is at record high too. And you know what happens during leverage buyouts? People get fired.
Right. Yet
the stock price
is 4.9%, right?
Yeah, the executives in leverage buyouts normally they get golden parachutes. Even the ones whose companies get acquired, they get golden parachutes to leave the company and sell out. But the shareholders often get screwed, and a lot of the employees get fired for the company that gets bought out. Sad.
I often reflect on, and with great amazement, at how shareholder interests are just not represented anywhere for the most part in American capitalism these days. It's one of the failings of the system because everybody, or a huge amount of the money under management in the United States is, generally speaking, other people's money administered by hands of people who don't really care much about anything beyond the 3-month quarterly windows.
Yeah,
and
that's a good point,
you
Eric.
marry that up with what goes on with the executive suite and the decision making that goes on in corporations, where you alluded to it a moment ago. These guys and gals are completely boxed in when it comes to an incentive system that also pushes towards making quote unquote business decisions that have very little to do with the health of the business on a long-term basis.
Right.
It's all about financialization and gaming and so forth.
Short-sighted.
If you had, I think any one of us could run Yahoo and lose as much money as Marissa Mayer. Okay,
yeah.
so when a person like that goes to the board and they say, look, we need to get Marissa Mayer. The board has this big discussion and they say, oh, she won't take anything less than 70 million. My hand is up and saying, I'll do it for $1 million. I will lose as much money as she possibly can, and I'll throw a better Christmas party. and it's amazing that people in they're all on boards of directors of each other's companies, and they have this concept in mind that they have to pay for talent. And I say Michael Jordan is talent. If Michael Jordan says, I won't take less than $120 million, I can't raise my hand and say, well, I'll do it. I'm 5'2", and I'm going to play for the Chicago Bulls. That doesn't work. But I know there are many people that if you have an executive who is stonewalling and wants all this money, there are plenty of other competent people who can run a company. It's not like it's a special unique talent with or without steroids hitting 700 home runs. That's a difficult feat. Not anyone can do it. Not over a course of a career, not in 1 year. But when you have these executives getting paid this amount of money and the board justifying it because this is what they have to pay, and then the company loses money, well, you could put a monkey in there to do that.
Well, the board's getting big stock options too, and they're getting large amounts of money to be on the board, right? So they're probably getting good amount of fees and expensive parties and access to the corporate jet, probably. Yes. So I mean, they're getting perks too. So they don't want to be kicked off the board, right?
Jason, they are probably CEOs of other companies.
Yeah.
So they're not going to talk about let's cut our own pay here. They're
and it also hooks up into a far bigger context too, just generically. I mean, we have an economic system overall and business culture in the United States that's just kind of like cannibalizing itself because of the nature of the short-term thinking. And then on a government/economic policy point of view, with this whole crazy Keynesian-infused way of trying to fix the past imploded bubble with a new bubble. It's just like dog chasing tail, round and round. And then when the stock market goes up, the government basically has its tool to disseminate the false reality of the economy doing just fine. And it wasn't all that long ago, in the last month, we've seen many examples of Obama coming out and talking about how we've created over 50 million jobs since the 2009 crash. And I mean, it's a whole, it's largely probably an effort of management of perspective economics, as Jim Sinclair sometimes calls it. Or, I mean, it's a peddling of a fantasy.
It's probably all those jobs, if they actually were created, if they weren't all birth death model, they're probably most of them part-time jobs, which are not going to do anyone a lot of good, because in order to pay your bills and be a functioning adult in society and pay off your student loan debt, maybe get married, get a car, have a family, etc., you're going to need 2 or 3 part-time jobs if you live in a major city. At least that's barely to keep your head above water. I mean, it's really tough out there. Lewis, in terms of any of the markets, do you see any value right now for investors, for people? The gold stocks have done really well recently. I think people should definitely keep accumulating physical precious metals. People should have some cash. Do you see anything else I don't see?
I think the only thing that I see, and I'm not making any recommendations, are stocks that pay dividends are ones at least you can say, and they're not borrowing the money to pay the dividend. If they're actually paying dividends from cash flow, you can say, well, that's a company that might be properly valued. You're getting appreciation on the price, and they're paying you a certain amount in quarterly dividend. Anything else, like these unicorn stocks, how do you properly value them? Companies like Zillow, they've been around 11 years, they grow revenue and they also grow losses. So how can you say that company is worth anything really, other than some valuation you want to assign to it just because it's gone up in the past? So I'm not a big fan of the stock market right now, other than ones where you can actually prove that the company has decent cash flow and decent prospects for profit.
You spent a lot of time focusing on the precious metal space. What do you think is in store for precious metals in the weeks, months, years ahead, wherever you choose to take that question? I'd love to know your thoughts.
Eric, I think it's wherever they want to take it. I don't think it has anything to do with supply or demand, because if, even according to the Silver Institute, if something's been in deficit for years, then by definition, there's a supply-demand imbalance, and whenever you have a supply-demand imbalance in a normal market, the price rises because people have to pay more to get something that's in deficit. Well, that hasn't happened.
When you say wherever they want to take it, quote unquote, who's the they that you're referring to?
The market makers, the ones that fix the silver fix, the ones LBMA and COMEX, where these things trade. You think about it, silver and gold trade on sentiment. That's supposedly market sentiment. And I mentioned this the other day to Rory on the Daily Coin, is you would think, why would sentiment be low when demand is exploding and supply is not keeping up? That's normally
the paper price is bad.
Are you making, just for my own clarification, because I also know that by asking this, I'm sure that a lot of people listening along are probably wondering as well too. I'm curious, are you making the argument that the precious metals will not have much of an ability, or maybe even no ability, to move much higher because of the nature of manipulation right now, and it will only move higher when manipulation either ends or tapers?
It seems to be, I think, the only way that the silver and gold move significantly to the upside if there is a massive amount of additional demand coming in, and it would happen more easily in silver than gold, because in silver, because you have the industrial component, if there were a massive increase, or just say another 100, 200 million ounce increase per annum in silver, and it had to be delivered, that would cut into the industry's needs. And if
100 extra ounces demanded by the market, regardless of where the demand was coming from, would send silver over $100 right now.
Exactly, because you would see industrial players would not balk at paying a higher price.
I mean, prices are always by markets, at least, on a longer term basis, absent, the annoyance of medium term and shorter term manipulation. Prices are set at the margin over the long term, responding to the fundamentals and whatnot.
But the difference with gold, though, is people buy gold for financial reasons. And those people that buy gold are satisfied with GLD, are satisfied with paper. So, because they only want the financial benefit of gold for the most part. There are people who buy physical gold, have it vaulted, allocated, and so on. But most of the gold investment, they're satisfied with the paper price. So
most of the gold
that's
investment
beginning to
on
change,
Wall
though.
Street. On Wall Street.
Yes.
I mean, it is beginning to change. There's an understanding among a very small, I can't even use the word small anymore, but, a certain percentage of the money under management of the conventional financial world is waking up to the reality that there's some darn legitimate reasons to be concerned about the underlying inventory of gold at GLD,
well,
et
look what
cetera.
happened at IAU. We saw Jason, you might as well explain what happened with that particular BlackRock fund, the gold ETF.
Well, I think there was a problem with them being able to register and sell shares, right? But I think there might be behind that problem, they might not have been able to correctly source the amount of physical gold because GLD supposedly is importing massive amounts of gold and the Shanghai Gold Exchange is withdrawing gold. And in the last, 4 or 5 months, 1,000 tons has been taken out of the LBMA and probably sent to China or the Middle East.
I mean, I'll address the BlackRock issue because I was pretty vociferous in making my point to SD Weekly Metals and Market broadcasts ago, and that is that this whole notion of them reaching their capital issuance limits and then exceeding it, and then that would be the reason why they had a problem with not being able to issue new shares, frankly, in my opinion, is a cover story. I can't, the notion of BlackRock not being cognizant of what is their capital that they've issued thus far at any given moment in time is analogous to saying somebody who has a brokerage account, a margin brokerage account, that guess what, you're completely oblivious to the fact that you went over your margin. I mean, they don't on a daily basis they reconcile where their net positions are and they know what's going on. So I find that whole BS story is just that, and the reality is that they got caught with their pants down and they weren't able to source enough gold. And I can't prove that, but since when would a Wall Street bank decide to not issue a product that's experiencing increasing demand of which they make transactional revenue off of by the marketing of it? I mean, come on. The only reason why they'd have any kind of real incentive to not issue more shares in reality is simply because they just couldn't get the gold to back up those new shares. They can literally change their capital requirements too. They can change.
Well, this goes back to my rule number one, guys. Rule number one is they're going to change the banks are going to change the rules. They have the most expensive lawyer. Louis, you're a lawyer. They have a lot of guys like you, or maybe even better than your case, or they have an army of guys like you who can figure out how to screw you over and change the rules.
Right. So here's what, to finish answering the question about whether the price would rise and what would cause it to rise, is in silver you would have to have physical demand overwhelm the supply, where the price would actually get set in the physical market, not in the paper market, because people would actually need the silver industry and investment. Whereas in gold, it'd be more akin to, well, people are satisfied with the paper price, so there's not a problem, unless something again happens more akin to what Eric was talking about in terms of IAU or GLD, where people are aware that a paper gold contract or ETF is not what they want. They actually want the physical. That's the only circumstance, I think, where gold and silver actually reflect the supply-demand dynamic, because otherwise they have a good lock on it through the paper trading.
In my opinion, it's already happening, and that's part of the reason why we've seen the mining shares move beginning in roughly August of last year. They're really, really deep-pocketed smart money, knows what the hell is going on. And part of the reason why they're allocating more capital into the miners is because A, it was bombed out beyond belief, and B, you're actually having title to real assets under the ground. And so you have seen an increase in the amount of capital flowing towards miners versus ETFs. And that's actually kind of refreshing, because back in the day when, the World Gold Council was advocating for the establishment of the GLD. I mean, everybody was singing the praises about, GLD is going to create all this new physical demand, and it'll be great for the industry, blah, blah, blah. And without even getting into the weeds about the analysis as to whether or not they actually have the gold that they have, if you just take it at face value, I mean, they just created a big, gigantic honeypot, and they're definitely, I mean, there's always been gold in GLD, and there's been a question as to, how much of phony accounting goes on and whatnot. But the reality is that particularly since April 2013, and for 2 years thereafter, you saw the ETFs formerly declared holdings halved. The whole notion of ETFs as, the ease of exposure to gaining exposure to precious metals by an increasingly significant amount of smart money, I think is changing. I think people are beginning to wake up. I mean, they're still in the minority. There's no doubt about that. The paper boys are definitely carrying the weight of what goes on in the markets. But it's kind of refreshing to see the growing skepticism about the nature of problems with representing of what's in our vaults, and whether or not gold and silver are truly non-encumbered. That's one of the biggest problems with central banks and Wall Street banks having accounts for private clients and so forth. I mean, it's not actually a theoretical proposition. Morgan Stanley was busted for representing the gold that they had for their clients, and it was actually I don't remember what
it was
oversubscribed, but I mean the allocation was an order of magnitude, multiple claims on every single ounce.
Yeah, they just ended up paying out a dollar amount, and a lot of people just took those dollars and went out and bought their own physical.
That's right.
Yeah, it was allocated silver, wasn't it? Weren't they holding like 20 million ounces of allocated silver for clients, and the silver wasn't allocated, it was gone.
They were charging storage fees on it.
Yeah, and they had been charging storage fees for a decade or something.
And then when it came time for people to get it, they had no reason not to deliver it to them other than the obvious reason they didn't have it. but they then settled, and they said, we don't admit any wrongdoing. Well, then why settle? Just deliver the silver. Well, they didn't have it.
Well, most lawyers nowadays, corporate lawyers, Louis, don't they want people to sign? They give people money to admit no wrongdoing. I mean, there's just so much fraud everywhere. That's one of the main reasons we decided to do this podcast, this particular one, Welcome to Dystopia. Is there's just so much pervasive fraud and immorality and things like that.
Going after settlements are a business model.
Sure.
Okay, well, if I could talk about the precious metal market, I think the perfect storm for me would be there is an increase in demand for physical metal, physical gold and silver, and then there's also supply problems with the miners. The miners get into problems where their mines, their production at the mine is dropping, or they're shutting down mines. They can't raise capital, so there's imminent supply problems then too. Now, in the short term, the miners, with this big rise in the precious metals paper prices, and also in the shares of some of the miners, you're going to see miners now go back to the market, and you're going to see some miners, hopefully not too many, you're going to see some of them, though, do some really stupid capital raises. The ones, who have mismanaged their finances, who have bad balance sheets. Some of them, the juniors, some of them will be doing it just to pay their CEO salary and things like that and stay on exchange. The ones who are smart will be, putting the money back into the ground and drilling and things like that. The smarter ones, who are the mid-tier producers, we're starting to see, they will do some prudent acquisitions. They will buy either cheap production that's lower cost, or they will buy a good project that has proven economics, and they will take it out at a pretty, even if it's a 40% premium, the share price is still down, 70-80% from the 2010, 2011 highs. So if you are going to buy gold and silver stocks, that's something I would look at. Why is the company raising money? What are they using it for? Is most of the money going into the CEO's salary? If it's a small company, what is the money being used for then? Now I want to get to the scumbag nominees. We're over an hour here, gentlemen. I could personally talk with you guys for another couple hours, but if we recorded it, I don't think most of our listeners would listen. So, but my nominees for Scumbag of the Week. Well, actually, we're not doing of the week, just scumbag nominees, are the CEO and Chief Operating Officer for the Wounded Warrior Project. It's a really sad story. The Wounded Warrior Project has raised over $1 billion, I think, since 2003, since the charity was incepted. It's for wounded veterans. I think now there's been investigative journalists into reporting this. The executives at the charity were giving themselves lavish salaries, way overpaid. They were spending a lot of money on these events and parties and things like that. And, you know, I think barely 50% of all the money that's been raised has gone to the people who really need it. And, you know, obviously there's a lot more charities who are like this. Government forces people to pay taxes and misallocates capital and causes high charities. But it's just really sad that, you know, there's a lot of, whether you agree with the wars or not, you know, there's a lot of people whose lives have been ruined who are veterans and their family members, their wives and their kids. And, you know, they obviously need some money for charity. The money was supposed to go to them, and instead, in a lot of cases, it went into the pockets of the people who are running the charity. Eric, do you want to nominate George Soros again this week? For
No, I think I'll leave Soros be for the time being. We've already picked on him twice. But,
yeah,
he's like our perennial champion, competing with Hillary.
Him and Hillary, yeah. The George Soros, one of our listeners should send us some George Soros. They should make some nice drawings, some caricatures of Hillary Clinton piñatas and George Soros piñatas. It would be kind of funny. Maybe put it as a thumbnail picture for one of our podcasts.
Yeah.
For piñatas.
I'm actually going to toss out a nomination that didn't get a lot of press, and that's part of the reason why I'm mentioning it. There's a judge who serves as a U.S. District Court judge in New York, and his name is George Daniels. And last week he issued a ruling, a default judgment, ordering the Iran to pay $7.5 billion to 9/11 victims' families, including a $2 million per victim payment for their estate for pain and suffering, and another $6.88 million for punitive damages. And, you know, Iran had absolutely nothing to do with 9/11. And this is a really nice crystallization and snapshot of just how politicized everything has become in the United States, and the propaganda, at least when it comes to, you know, geopolitics and the organs of the deep state and what it seeks to achieve on the world stage in pursuit of our empire and our interests. Are so just loopy that something as unbelievably easy to prove is just nonsense can in fact be issued by a major judge, and a court ruling like this can, you know, be thrown out because the judge somehow, some way is following either a completely ass-backwards understanding of what's gone on, and I can only speculate as to what was actually presented to the judge in the courtroom, but it also could very well be that he's just compromised. And the net result, regardless of how this actually happened, is really the bottom line import, and it speaks to how our system is captured by a set of interests that pursue warfare and domination in an empire model, and it's so desperate to preserve that operating social compact that we have that we get things like this. And it's a great example of just how crazy things have become. I mean, Iran, again, had absolutely nothing to do with 9/11, but completely out of the blue, more than a decade later, we have a judge making this crazy determination. It's
probably trying to sell a book or something.
I'm sorry, say that again?
He's probably gonna get some extra publicity out of this, maybe a book deal or something like that, so he can make some extra money out of it. Maybe
Who knows?
He was
I
using
mean,
it
there's
as a
definitely
marketing
something
tool.
weird going on here, because this is like saying the moon is made out of Swiss cheese. It's that loopy.
It's just there's just so many examples of this. And my last one that I brought up here for the Wounded Warrior Project, both the CEO and the chief operating officer were finally fired, guys. So I don't remember if I said that or not before Eric mentioned his. Lewis, do you have any before we wrap it up here?
Other than Trojan, I have no further nominees.
Trojan?
Yeah.
Do you care to expound?
They're the largest prophylactic maker in the United States.
Okay. And they are a scumbag because?
They make them.
So in other words, you're against any kind of contraception? I'm not sure what. I mean, flesh out your argument. What do you think?
It's not an argument. I'm not participating in the nominees.
What? Oh, that was an attempt at a joke then?
Something like that.
Okay.
Okay. Well, we'll get you to work on your jokes before we have you back on. But
I thought I deflected the question.
Okay. Well, I really enjoyed speaking to you today, Lewis. You have great insights and you have a great website and good articles. We didn't get a chance to talk about your Austrian school article, so we'll save that for another time where we can talk about, entrepreneurs being given false signals and things like that. I mean, there's a lot of crooked people who have made money off, the mortgage market being manipulated with the Federal Reserve interest rates and things like that, and the technology market. We'll talk about that another time. I just want to thank you again for your time, Lewis. And how can our listeners find your articles?
Oh, just go to smallgold.com, SMAULGLD, and you can subscribe there, and I'll send you the articles as they come out. So it's smallgold.com.
Hey, and before you go, how'd you come up with the name? Really curious. I'm sure a lot of other folks are wondering too.
It's hard to say. I really don't know how I came up with it. I kind of was just putting together syllables and vowels, and that's kind of what came out. I was looking at, actually, at the time, the movie, one of the Lord of the Rings movies was coming out with this Smaug, and I was writing that, and then I think maybe GLD was around, and I kind of put the two together. And if you could say SMAUL is small, and then GLD is gold, so it could be small gold, but that wasn't what was intended.
Yeah, I thought that sounded like the dragon's name. I didn't know before you just said it right now that it was connected to the dragon, but, intuitively reading the name, I was like, oh, that's the dragon. And everyone knows from the movies, it loves gold and shiny objects like the gemstones. Yeah. And they remember from the movies that, it broke into the dwarves' main capital. Well, without going into any further details.
Okay,
yeah, it loves gold. Yeah. Okay, great. Well, thank you again for your time, and we'll have you back on in the near future.
Thanks, guys.